All right, so I'm going to say good morning again. My name is Monica Jean. I'm a field crops educator based in the Saginaw Bay region, and I'm here to host another virtual breakfast with all of you. So thank you for choosing to join us this morning, and maybe you're eating your breakfast or maybe you're already out working on the farm, but we really appreciate it. All right, so Matt Gammans is here to talk to us about the carbon market, and he's an agricultural economist at Michigan State University.
Thanks, Monica. Thanks, everyone, for being here today. Struggled a little bit on the title, so I'm definitely going to talk about carbon markets. I'm also going to talk a little bit about kind of policy in general, mostly policy that's pretty related to carbon markets, kind of environmental programs run by the USDA. And then I just have one slide, just in case you missed it from everywhere else, just like 3 sentences about the latest WASDE, just so you at least kind of know what direction things are going. I know that you have a lot of other probably good resources for that, but just wanted to have it in here a little bit. So yeah, my name is Matt Gammans. I'm an assistant professor in the agricultural econ department here at Michigan State. So carbon markets, carbon credits, probably hearing a bit about them. It's possible you've seen this slide before. The rest will be new, but just kind of a quick refresher. We want to think about these credits as representing an amount of carbon that's either not emitted or is sequestered on the farm. So this is kind of, you have some sort of baseline. You know, your farm is taking carbon out of the air, putting it in the soil. You're also releasing carbon. That's some baseline. Something changes, and then there's some different level. And that difference is kind of something that, if it can be documented, it can potentially be sold through some of these programs. So we really want to think about these not as, you know, growing carbon. I know that's kind of a buzzword right now, but I would really think about it as just kind of a payment for a change of production practices and the associated documentation that goes along with that production change. There's a lot of different practices that qualify, but the big two, the overwhelming two, are cover cropping and no-till. So especially in row crops, these are really the two that we're thinking about. So steps here, reaching a contract with one of these kind of many programs, a lot of them organized by names that you're going to be familiar with, you know, Indigo, Bayer, ADM, setting up a contract with them, then a documentation process where you're kind of showing that you're doing what you said you're going to do. And then a price. That price can change over time. So typically what happens is, you know, you lock in some minimum price, and then you're still going to be allowed to kind of get the upside if the price increases. You know, ultimately kind of leading to a payment. And we'll talk a bit about kind of what the size of that payment can be. You know, the headline result right now, I think, is these payments aren't big. So there's a lot of programs. We've seen a lot of activity kind of in this marketplace, but I think we still have yet to see kind of proof that these can be, you know, big time profit increasing for most people. But there's going to be a few exceptions and a few cases where I think they really might make sense for some folks, and we'll talk about that at the end. Kind of nationally and even internationally, you know, prices for carbon credits, and kind of think about it as a willingness to pay by consumers and governments for more carbon friendly practices is going up. So this is from the New York Stock Exchange's kind of index of carbon offsets, which you can think about as a carbon credit. So this is not just specifically tied to ag. This could be forestry or in the energy sector. People, again, making changes to their production practices. They're going to have, you know, less carbon, and then going to the marketplace and trying to sell it. So, you know, just in the past month, we've seen a 30% increase in these prices. And these are also way up from last summer. So about double the prices that were being sold last summer. So that doesn't mean that kind of the contract that you come up with might not have this exact price, because these aren't kind of a perfect commodity. Sorry, these aren't like a perfect commodity the way that, you know, number 2 yellow corn is. You know, there's quality differentials, and it's going to depend on your specific circumstances. But we can say that overall, kind of across the board, the demand for this is increasing, and so the price is increasing as well. And so, you know, what's driving that? This is really kind of, these price changes are driven by the demand side. So there's been kind of increasing interest of mostly corporations, particularly large corporations, and kind of documenting to their consumer base that they have environmentally friendly practices. So, that's something that they've kind of always given lip service to. And these new markets have given them an opportunity to kind of actually pour some money into it. And a lot of them have, taken that opportunity to do that. And, when they pour money into it, the price goes up. There's more demand, price increases. So, I'm not a shill for Indigo, but I do think that this example kind of illustrates, what's changing. So last summer, Indigo had financing at $20 a ton. So $20 per ton of CO2 that they could show was being kind of sequestered on farms. They recently secured financing at $40 a ton. So that's, a doubling in 1 year. So that's a big change. I get this question a lot, kind of, we see these numbers out there, and those are not the numbers that farmers get. So they are not really the number that matters. Carbon could be trading for $100 a ton, but if farmers are only getting $20 of that, then, who cares? So for this case, farmers would receive $30 a ton, so 75% of the overall price. And then who's getting the difference, right? So some of that is going to third-party verifiers, right? So these aren't Indigo employees. These are kind of other companies that they're going to hire to bring in to kind of verify that their systems are in fact reducing carbon. And then, they don't release all their financials, but presumably there's some left over that's going to just kind of go for Indigo to, pay their overhead and then also take a profit. So I know there's a lot of interest sometimes in kind of how much profit are these folks making off these. I'm not privy to those numbers, but it's definitely not zero, right? These people are getting into these markets because they think there's a profit opportunity. So again, these numbers, even if you have the $30 per ton that would be going to the farmer, you kind of still don't have all the information you need, right? Because, who really knows what's in a ton of carbon? What does that really mean? So I did some kind of rough back of the envelope calculations, and, don't take this to the bank, but, if you're on kind of what NRCS would call kind of highly erodible soils, these types of prices would be equating to a payment roughly in the ballpark of $9 an acre for going from no cover cropping. So cover cropping was something that was not part of your operation to cover cropping. So $9 an acre, that's not like fantastic. It's not going to like save the farm. It's not some miracle. But relative to where we were last summer, where I think the cargo program and maybe Indigo as well was, offering $3 an acre for cover cropping, which is like kind of laughably low. $9 is a lot better and starting to kind of get in the ballpark of numbers that kind of seem serious. So one question in the chat, were the values on the so on the graph I show, so this is an index. So I think it roughly maps to about a tenth of a ton. So no, so those numbers aren't indicating $4 a ton. But yeah, it's a kind of an index of across different offsets. So it kind of depends on the time scale that you're sequestering for, kind of what the value is. I wish I could give you a clear answer, but it's a little hazy to me as well. So those are kind of big macro level changes in these marketplaces. In Michigan, the story is mostly that more folks are getting in. So more companies are deciding that it's kind of worth their time to start programs here rather than just stay in the I states and try and make their money there. So new program offerings from ADM, who's partnering with the Farmers Business Network, Corteva, Cargill, all these programs are new in 2022 or coming in 2023. So these programs are pretty much always rolled out with kind of digital platforms. So if you're familiar with Climate Field View through Bayer, these are things that they want you would have first. These are sort of, you have to pay for this service to even kind of get in the game and be eligible for enrolling in carbon credits. So you should really, if you're not in these right now, you should think about that as kind of like another step that you would have to take, is you would have to kind of first be enrolled in one of these digital platforms, and then kind of applying to share your data from these platforms with them to allow you to be enrolled in these programs. So another question from the chat. Do you only credit on changes to practices? So the short answer to that is yes. All these programs want to see kind of a documented change in practices. Now, kind of some of these programs, Bayer's in particular, will allow you to go back a little bit in time and get kind of credit for recent changes that happened kind of before you enrolled. That's not the norm. The norm is they really want to enroll you, then have you change, and then kind of only pay for the difference in practices. So that is kind of, understandably really frustrating to a lot of folks who have been kind of engaged in some of these practices for a longer time period. It's something that I really hope is kind of addressed in the 2023 Farm Bill. And I think increasingly kind of the ag community is kind of united in their efforts of communicating the need for kind of some ability to compensate for past practice changes, through these markets, or through kind of a government substitute of these markets. So I'm hopeful that will be part of the conversation in the 2023 Farm Bill, because yeah, you don't have to think too hard about it to think, if doing these practices for free means I can never ever get paid, and other people are, maybe I just won't do them at all until I really have kind of waited around for the price to be right. And that's kind of not what these programs want, right? They do not want to like incentivize people, not doing things that they're interested in and that they would have potentially done anyways. So that's kind of the reverse of the point. And so I think that's a policy problem that I think is kind of increasing in salience, which is good. Okay, I'm being told I'm going too slow, so I'll pick up the pace a little bit. I think I should be still done on time though. So yeah, these digital platforms, the pros and cons, they're much broader than just these programs, right? So pros, easy monitoring, less paperwork. That's true just across the board. That's a benefit of these programs. But the downsides are, a lot of the data ownership issues. Who really owns this data? And then at an industry level, if these, handful of companies kind of can enroll you in a long-term contract and they have all of your information, but, you don't have any of the information that they're collecting from other folks, there's a market power concern that they might be able to kind of use pricing mechanisms that are kind of not fair, basically. So expanded offerings overall across the state, but still very limited for specialty crops. So these are a couple things at the federal level that are not passed yet, that are, potentially in play in the near future. So, last summer, I think I probably told you that the Growing Climate Solutions Act was very likely to pass. Well, kind of have egg on my face on that one. It has been stalled in the House for a full year now. It's honestly not clear to me why. It looks like the votes are mostly there. But at this point, I think it's pretty likely to be scrapped and rolled into the 2023 Farm Bill. What this would do is it would kind of, rather than having kind of all these private actors who are, calling themselves verifiers, it would set up a process for these actors to get accredited through the USDA, basically having kind of a common set of guidelines on kind of what constitutes, good carbon credit and what sort of measurement protocols are accepted and what sort of measurement protocols aren't accepted, and having that be authorized by the USDA. A good chance that kind of, if something like that were to come through, you'd see at least a little bit increase in prices as kind of the buyers of these had more assurance that they were paying for something that was kind of real and meaningful. Also have the No Emits Act. This is introduced by a Republican out of Illinois. And basically what this would do is it's adding a soil health transition incentive to the USDA's Environmental Quality Insurance Program, EQIP. Well, you'll hear more about that in just a second. And that would kind of increase by 90 million payments to farmers. And it's not clear to me yet kind of how this interacts with my next slide, which is the recently passed Inflation Reduction Act. So I'm only going to talk about the ag components of this act. So it's a big spending bill, a big spending law. And I just want to kind of break down the ag components of that. So you probably heard about this in the news. It's not an ag bill on the whole, but there's still 20 billion in ag spending. So it still has kind of big implications. And most of that is going for programs that look pretty darn similar to some of these carbon credit programs. So $8.5 billion to the USDA EQIP, and these are mostly to go out and increase funding for NRCS to set up contracts with farmers for cover cropping. So that's kind of a lot of money that wasn't in the USDA's coffers to pay for cover cropping that now is. So, that's going to just kind of, again, flood more of these markets with kind of more demand side dollars. In addition to those $8.5 billion, we have $3 billion for the Conservation Stewardship Program. This is for people who are already enrolled in some conservation efforts and looking to expand. So this is kind of a good option for people who might be kind of frozen out of markets based on kind of already doing a lot of these practices. And then a little bit for the Ag Easement Program. I'm going to skip this. Basically, what this pie chart shows is about half of that 20 billion is for conservation dollars, and half is for other rural development and forestry of the Ag Committee funding. So USDA EQIP kind of versus carbon market, private carbon market programs. These programs are similar in spirit, documented changes on farm leading to a payment with the goal of kind of environmental protection. Historically, EQIP hasn't been, really carbon focused. I think politically the winds are changing on that. I think kind of going forward, kind of carbon saving practices are going to kind of be boosted up in EQIP and are going to be more of a priority in enrolling in these programs. This is in bold. Don't enroll in a private program prior to trying to enroll in EQIP. Go the other direction. So it's not clear yet that EQIP will kind of allow you to be eligible if you're kind of already enrolled in a private program. There are still a few private programs that will take applicants who are enrolled in EQIP. So don't try to go kind of private into EQIP. That's kind of my best guidance at this point. If you're in EQIP currently and find an opportunity to enroll in carbon credit program on top of that, that's a good deal, and that deal could go away. So in general, my advice is these programs, kind of wait and see. An exception to that is if you kind of get paid twice for the same practice change, that's a pretty good deal and something that you should consider probably pretty seriously. Markets are changing fast, still a lot of uncertainty. Prices are increasing. I think that's likely to continue. If you're already thinking about some of these practices, they might make sense. If you're not, they probably don't. The dollars involved are just not enough to, go out and, do something that you're not interested in and don't want to do. And, shopping around, always super important. All right. I ran through my time too fast. WASDE highlights, corn yield estimates are cut, more supply coming out of Eastern Europe. Wheat supply and demand are both projected to increase as we go into the fall and winter. So kind of unclear price implications of that. And soybean stocks are projected to go up. So those are kind of the top line numbers out of that. Thank you so much for your time. And yeah, happy to do questions. Otherwise, hand it over to Jeff.
All right, thank you, everyone. And so it looks like we just had a couple questions in the chat. So far, they're for Matt. I think you already answered the values that were on that graph. So I'm gonna move on to, do you only credit on changes to practices?
Yeah, I think I kind of answered this one too. So the norm in general is yes, these need to be changes. It's kind of a concept that in economics we call it additionality, which is the idea that these need to be additional changes. So that's what these markets want to incentivize. But as I said, there's a very clear problem, right? Which is that if you kind of only pay for additional changes, then you give people an incentive to, sit around and wait, or tear up their cover crops and not do it for 5 years and then try and get back in. So there's definitely kind of opportunity for better, clear policies on that. How far back is the look back period is a question in the chat. The Bayer program goes back 5 years. I'm pretty sure, I would have to check my notes, but I'm pretty sure Bayer looks back 5 years. But most of them don't look back at all. Most of them want fully additional programs. Fully additional practices. Yeah, so I'm hoping that we get some more clarity in the 2023 Farm Bill. it would be good to have, I think, more shared guidelines on look back periods that are bigger than 0.
And Joe, I see your question. I'm going to go ahead and grab that link, and then I know what the details are right now. There is an MSU registration link, so I'll go grab that in a second. And it's supposed to be very hands-on, where you come and the specialists are there. They wanted smaller groups. I think right now there's still 40 spots open for registration. And this is, by the way, a B&B diagnostic field day. I think it starts at 8:30 in the morning, and it would be, I should say the date as well. I believe it's Tuesday. Yes, the 23rd out at Saginaw Valley Research and Extension Center. So the B&B diagnostic field day. And so let me go grab that link. I think that should be all the information, but if you guys have any other questions, you're welcome to add that in the chat as well.
Matt, I was going to ask you about the latest report that came out. Could you give us a little more detail? You went through that kind of quickly, as far as supply and demand and how that's going to affect our prices going into the fall.
Yeah. So I can't necessarily give you a ton more detail because I just kind of went through the summary myself. The big line numbers are that due to some weather issues and then some increased supply out of Eastern Europe, corn is looking, that those prices have kind of downward. Sorry. So it's offsetting actually. So there's more supply, but then also there's kind of weather issues in the U.S. So it's a little unclear what will happen kind of with prices there. The yield was cut by 1.6 bushels, was kind of the USDA's yield estimate is down. Most of the private forecasts have something similar or even steeper declines projected, again, due to some of the weather issues. Wheat, I think there's kind of increasing optimism that there's going to be a big supply response, especially out of areas in Illinois and areas kind of farther west, increasing wheat acreage. So I think there's kind of expectations for a big supply response there, which again would then kind of maybe temper some of people's expectations for price increases. So I mean, everyone knows that we're in a big wheat shortage. We need way more wheat, and I think increasingly people are kind of optimistic that we might get it. So so that's kind of some downward pressure there. For people who want kind of a really in-depth summary of the WASDE report, Purdue University puts out a really great YouTube video. So it's a couple of their economists there, and they kind of go through really slowly. It's about an hour total, and they'll talk through kind of all of the changes to stocks and supplies, and they do a really nice job. So if you just Google kind of Purdue University WASDE update, it should pop right up. And so that would be my recommendation for folks who are interested in a more kind of extensive overview. Sorry, I don't know if that was helpful or not, Phil, but that's what I got.
No, that was fine. Thank you, Matt.
All right. I will just pause for a second, see if anyone else is submitting a question. Mention that next week, of course, we have an additional virtual breakfast. It's the Q&A again. So, fortunately or unfortunately, you'll see me again. I'm the host for those as well. So please think of any concerns you have. And actually over the week, if you even want to submit them to me, and I can go ahead and make sure those specialists are on, I can put my email in the chat box. Is there any other specialists that have updates?
This is Chris here. Can I do an update?
Of course.
So one thing that's happening is in these dry areas, you saw the map, it showed the thumb and then a little bit of central Michigan. That's kind of the area where probably mite infestations would still be present. But for a lot of the rest of the state, if you plant it on time and you have a canopy, we're getting those sort of juicy mornings. And underneath that canopy, this is where the entomopathogens come in and wipe the mites out. It's called neozygites. It happens very quickly. So the damage might still be there on edges, but this is the time of the year where it's making that mite control decision is really difficult. It's easier at the beginning of August, but now we're in that sweet spot where biocontrol is beginning to come in. So a lot of times it doesn't pay, even if it looks gross. So if you're late planted, there's no canopy, it's dry, you're up in, I don't know, the thumb area, and you're looking at that field and it just looks terrible. For corn this time of the year, it doesn't usually pay out at all. I mean, we're past corn, but maybe there's a few fields, and be really careful what you spray, because you can flare those mites right back if you spray a product that doesn't kill them. And there's many products that don't kill them. So,
Chris, should we be looking for fall armyworm this year again? I didn't see
we've
any
got
indicators.
traps out, and I've got 0, 0, 0, 0. There was a huge number of fall armyworms in Texas, and I thought for sure we'd catch a flight, and we just didn't. I think I've caught 2 so far or something. That's a good question if I should look at the map here, but I've heard nothing. It has been like crickets as far as, but last year, probably it would have been early August where that flight would have come in that then led to the forage damage. That's what I'm guessing. So I don't have any, is what I'm saying. I haven't seen any.
I have had very few as well.
That's what happens. If you trap, you get rid of them. If you put some money into it, a few bucks, you get rid of them. So.
All right. Well, any other specialists have an update? Thank you, Chris. With that, thank you for joining us for another virtual breakfast, and we hope to see you next week.